Okay, what's going on, traders? So today we're back with another exciting lesson just for you. Okay, so we get a lot of questions from our subscribers regarding how do they build their own trading plan. So we come up with this PowerPoint slide, or rather this YouTube video, to share with you how you can actually develop your own trading plan. Okay, so this is the 7-step process that we use. Okay, so when it comes to trading plan, you need to understand that the trading plan is something that is very personal. So it's something that it might work for me, but it might not work for you. Okay, so that's why whenever you design a trading plan, you need to consider your own psychologies, right? You need to consider your own beliefs about the market. For example, are you a short-term trader? Are you a long-term trader? How often can you check the charts? So there's a lot of factors to consider, but this video will cover the 7 steps that will take you from, not having a trading plan into having a trading plan. Okay, so of course, you need to follow each of these steps. Okay, so the first step is that you need to understand your trader profile. Okay, so what is a trader profile? Trader profile basically means what kind of trader are you? Okay, are you a scalper? Okay, do you like to day trade? Are you a swing trader? Or are you like a position trader? Okay, this is very important to establish. Okay, one more thing that I want to highlight is that maybe you want to day trade. Okay, you like day trading, you enjoy it, but maybe you are working, maybe you have a full-time job. Okay, so it's not possible for you to day trade. So in that case, even though you like to day trade, but your lifestyle, right, doesn't fit a day trader lifestyle, because maybe if you want to day trade, you need to be staring at charts the entire day, and that requires you to be at home instead of at work, working for someone. Okay, so make sure to consider not just what you like to do, but whether your current lifestyle is able to accommodate it. Okay, so if you are still struggling as a trader, do not quit your job yet. If you have a job, right, don't quit your job to trade, because it's been very stressful for you, and you haven't proven to yourself that you are able to make money consistently. Okay, so what you should do is try to fit your profile, means what you like uh, with like your lifestyle. So if let's say you you are working, okay, and you can only see the charts in the night, so you might want to consider swing trading in the night. Means every night when you go home, maybe that's like 8 p.m., right, 9 p.m., go home, take a look at the charts, okay, and say, okay, I'm going to take this trade, and I'm going to close it in maybe within the week, or I just hold it for a couple of days. Okay, so step number 1 is you need to identify your trader profile. Okay, so now let's move on to step number 2. Okay, so step number 2 involves risk management. Okay, risk management is very, very important. In fact, risk management comes even before trading strategy. You notice over here that point number 2, or rather step number 2, is risk management, not about strategies, not about how to take profit, not about your stop loss, but your risk. Okay, because in trading you can never get it right 100%. Okay, think about it. You cannot even get it wrong 100% of the time, right? Even if you want to lose money every single time, you can't lose money every single time. So why do you think you can expect to make money every single time? So you can't, right? So that's where risk management come into play. Okay, it doesn't matter how profitable a strategy is if you do not have risk management in play. So always have your risk management in play as part of your trading plan. Okay, so normally we recommend to have just like 1 to 3% per trade. So if let's say you're trading a $10,000 account, 1% would be $100. So each trade you should risk $100. Okay, so of course there's different types of risk management. There is adaptive position sizing, which we teach. Okay, if you have not watched this, watch our other video about how to position size your trades. Okay, if not, you do a fixed position. So what's the difference? Okay, in adaptive, it means that let's say every trade you risk $100. Okay, and it considers that each trade you have different stop loss. Maybe this trade you have a 30 pip stop loss, next trade you have 100 pip stop loss. So of course, if your stop loss is wider, then you're going to have a bigger position. Sorry, if your stop loss is wider, then you're going to have a smaller position size. Okay, but if your stop loss is tighter, okay, that means you want a bigger position size. Okay, that's adaptive position sizing. Okay, fixed position sizing means that for example, every single trade you trade 0.1. Okay, 0.1 is actually a mini lot. Okay, we don't really recommend this because if you're not careful, okay, and you have a trade which has like 100 pip stop loss and you trade 0.1 versus a trade that has 0.3, okay, the 100 pip stop loss is going to damage your account quite badly, correct? Because you are trading 0.1, you're trading a bigger position size even though your stop loss is wider, okay? So, but a fixed position sizing is the fastest way, it is a better way to grow your account because you, in a sense that you are trading bigger, okay? And when your stop loss is wider, you're still trading big, okay? But if you are a beginner, we still recommend towards adapting the adaptive position sizing, okay? So check out other video. Okay, now to the step 3. Okay, step 3, we want to talk about market conditions. Okay, so your trading plan has to define what kind of market conditions that you are trading. Are you trading a ranging market or are you trading a trending market? Okay, so if you are trading a ranging market, that means ideally you want to sell high and buy low. Okay, you need to define in your trading plan. Okay, let's say this is it's bullish, but it's in a range. Are you allowed to sell the top or are you only allowed to buy the bottom? Okay, so means if you are in an uptrend but price is ranging now, can you just buy? Can you buy and sell or can you only buy? Okay. Conversely, the other market condition that we want to talk about is trending. So trending, I think as the name suggests, I mean, everyone knows what a trend is. Trend means that it's going one direction. Are you trading this kind of trends? Okay, if you are trading trends, right, are you going to trade breakouts or are you going to trade, just buying off support? Okay, so you need to define your market conditions. Okay, now let's move on to step 4. Okay, step 4 is the instruments that you are going to trade. Okay, in our channel, we trade Forex, but this trading plan is not like this 7-step process. It's not restricted to Forex, okay? Regardless of whether you're trading stocks, options, futures, indexes, whatever, you must always have a plan in play, okay? So we always say that, it's a very common saying that if you do not plan, you plan to fail. Okay, and that's very true when it comes to trading. Okay, most people lose money because they don't prepare. Okay, on Saturdays, Sundays, they're out having fun with their family, and that's all good. Okay, but if you've been following our channel sometime, you know that every Saturday is our preparation day. And the reason why we are successful is because every Saturday we look through the trades that we've taken and we look through the markets, right? We plan ahead, we prepare. Okay, we prepare hard using this trading plan that we have created. Okay, so next on, let's move to step number 5. Okay, now step number 5 involves a strategy. Okay, strategy is very similar to market condition. So once you define a market condition, okay, your market condition will kind of determine your strategy. Okay, because if you are trading a trending market, if your trading plan involves trading the trending market, then ideally you'll be looking at a pullbacks, means pullbacks to support, or retracement, right? Pullbacks the same as retracement, or you want to trade breakouts, okay? Then if you are trading a ranging market, then of course your strategy will be the range, okay? Then as we said earlier on, if it's a range, are you allowed to buy and sell both ends of the range, or are you only allowed to follow the trend? So if it's uptrend, you only buy. If it's a downtrend, you only sell the top of the range, okay? So moving on to step 6, okay? Having a stop loss. Okay, stop loss is part of kind of very similar to risk management. Okay, risk management deals with how much you risk, but stop loss deals with when to get out. Okay, you need both. You cannot just have one. Okay, you cannot just say, oh, I risk 3% and I don't have a stop loss. Okay, it doesn't work that way. Okay, if you risk 3%, right, you have the right position sizing, but you don't put a stop loss. Okay, that position size can still blow your account. Okay, if price just trends against you massively, doesn't come back, just keeps trending, your 3% loss, supposedly loss, right, because you're supposed to put a stop loss there, becomes a 10% loss because you do not have a stop loss. Okay, so we always advise you to put your stop loss below above market structure. Okay, put in an area which if the stop loss is hit, then you are likely to be wrong. Okay, don't just put it anywhere. Okay, because you put it anywhere, the brokers like to, sorry, not really brokers, but institutions, they like to hunt your stop loss. Okay, because you must understand that trading is a zero-sum game. Okay, meaning that for me to make money, you need to lose money. Okay, so I will push price against you to stop you out so that you lose money and I make money, right? The moment you get stopped out, I enter. Okay, so when you sell, I buy from you. So that's how the market works. So always put your stop loss, somewhere which is unlikely to be hit. And if it's hit, that means that you are wrong. Okay. Okay, and now the final step. Okay, the final step deals with trade management and take profit. How are you going to take your profits? Okay, you handled the downside. Okay, most importantly is to handle the downside. But once you have the downside handled, the next question is take profit. How do you take profit? You need to have a take profit plan. You cannot just assume that market will always trend in one direction. Okay, you've been trading some time, you know that the market rarely trends one direction. Okay, it always comes back and forth, back and forth. So you need to have kind of like a strategy to take profit. Okay, so there are two ways you can do it. Number one is fixed target. Fixed target means that, okay, I'm risking 30 pips for this trade, so I'm going to take 30 pips, right? Because you want to take 1:1. Okay, nothing wrong with that. You can take 1:1, you can take 1:2, 1:3. That's totally up to you. That's how you set it. Of course, as you continue to trade and as you diligently journal down your trades, you have insights about, oh, actually I can actually take 60 pips, I can take 90 pips. Price tend to hit 60 pips. Price tend to hit 120 pips before it reverses. Then you can revise your trading plan to fit this. Okay, but for a start, you can try fixed target. Okay, 1:1 is a good 1:1, meaning that if you are risking 30 pips, taking profit at 30 pips gain, or rather shifting stop loss to break even at 1:1 risk to reward, it's suggested. It's rather a common practice. You can do that. Alternatively, you can do a trailing take profit, meaning that you just keep shifting your profit, your stop loss right higher. So as as the trade takes off, you just keep shifting your profits up, meaning you don't actually close the trade, but you let the trade run. Okay, and then when price starts to reverse, it stops you out at your stop loss, which is already at a profit level. So basically just shift your stop loss higher and higher and higher, or lower and lower and lower, depending on whether you are buying or you are selling. Okay, so these are the 7 steps that we use. Okay, so just as a brief recap. Okay, number one, we talked about a trader profile. Okay, you need to know what kind of lifestyle you have, and what do you like doing. You need to match the two. Okay, step number 2, we talk about risk management, how risk management is the most important part. Step number 3, defining the market conditions that your trading system or trading strategy revolves around. Step number 4 would be the instruments that you wish to trade. Step number 5 would be the strategy. Okay, the strategy is closely linked to market conditions. And number 6 will be the stop loss. When are you going to get out? Okay, because it's not important. It's not just pivotal that you have proper risk management, but you must exit when you are wrong. Okay, that's how you reduce your losses. And step 7, we talk about how you need to take profit, right? Because market doesn't always trend one way. Okay, so this sums up this lesson. Okay, if you need more help for our trading, coming out a trading plan, or if you have a question, a comment down below, write into us at support@financialmarketwizards.com. Okay, and if you're new to our channel, please subscribe. Okay, we're trying to come out at least 2 videos like this every single week to teach you more, right? To cover the basic concepts, because we understand that a lot of you do not have a firm understanding of the foundations. Okay, and we always say that you need to have a strong foundation, because whatever you build, right, tricks, strategies, tips that we give is built on your foundation. Okay, so if you don't have a strong foundation, then building all these tips and tricks on top of it is not going to work. Okay, so you need to have the basics nailed down. Okay, and this is one of the basics that you need to have if you want to be a profitable trader. Okay, as always, if you have any questions, let us know, and we'll see you in the next video.